This is the first lesson from the video Options Trading for Beginners, the ultimate in-depth guide.
On YouTube, my name is Chris, and in today's video, I'm going to explore the world of options trading with you, even if you don't know one thing about options trading. I will be explaining the most important options trading concepts to you using examples, lots of examples, and visualizations so that you can understand and actually see how options work in the real world. My goal is to provide you with all the information that I would put into a beginner course, but give you everything for free. So with that being said, grab your favorite beer, your favorite wine, kombucha, or whatever your thing is, and let's get started. So the first step in our options trading journey today is to first understand and learn about the basic option characteristics that all options have, and briefly discuss how options are different from shares of stock. Option characteristic number one is that all options have an expiration date. This is different from shares of stock because if you buy a share of a company's stock, there's no expiration date on that position. You can hold that share of stock forever as long as that company doesn't go private. There's nothing that's forcing you from closing that position. But with options,
hang on. I want to interject as we go. Now, this is what makes options unique, but it also is what hoses a lot of people, right? Because when you go to an options chain, you have all of these different expiration cycles, right? There's some that are weekly, there's some that are monthly, there's some that are quarterly. But if you are looking to hold on to an asset, you shouldn't be doing it with options. You really shouldn't, because all options have what's called extrinsic value. And it doesn't matter how far out you go, it has extrinsic value. It doesn't matter how far in you go, it has extrinsic value. Extrinsic value decays over time. And if you are trying to hold on to something long term because you consider yourself a long term investor, you don't want to be holding something that is decaying day after day after day. You really are better off just buying the stock outright. But that does make a giant difference. It makes a humongous difference.
As long as that company doesn't go private, there's nothing that's forcing you from closing that position. But with options, all option contracts have an expiration date, and the expiration date could be today or it could be 2.5 years from now. And that means that when you are trading options, you have to choose a time frame for your position. Now, this will make more sense when we go through the examples in just a second. But the first thing to know is that all options have an expiration date, and after that expiration date, that option will no longer exist. Option characteristic number two is
good point. It will no longer exist is such a good point. I'm glad you mentioned that, right? Because you can't go back. You can't go back and be like, oh, you know what? I really wanted the one from April. Now we're in May. It doesn't exist anymore, right? Consider it like a coupon. And he may talk about this later. Your coupon has an expiration date. Once that expiration date is gone on that coupon is nothing. It's just trash, right? So all options have an expiration date. And when that expiration date comes and goes, the option no longer is an option for you.
Is that all options have what is called a strike price. The strike price is the price in which the option can be converted into shares of stock. And exactly what that means is that if I have an option with a strike price of $105, that means that in the future, if I want to buy or sell shares of stock using my option, I can do so at the option strike price of $105.
So let's go back and talk about how this is like a coupon. And surely he'll give some examples in a minute. If I'm looking at SMCI and I buy the 38 calls, right? I just got out of that trade yesterday, the 38 calls in SMCI. I am saying that I want to buy the stock at $38, but the stock is currently trading at $42.77. So I'm buying the option, the choice to buy it at 38. Now I have to pay for that option, right? Because we're not getting it for free. It's the 38 price plus how much I'm paying for it here is what we're really looking at. Okay. So if I were to exercise this option that I bought today, I would still have to pay, let's say I bought it for $5.45, and then I'd have to pay an additional $38 per share. So $5.45, hold tight here, 5.45 plus 38 is $43.45, which is about $1 over current price. 42.77's current price, 43.45 is the actual price of the stock. And that difference there, that's your extrinsic value that we talked about that will decay. So it is giving you the choice to buy the stock at a lower price.
I can do so at the option strike price of $105. So this is really important, and it doesn't have to make sense right now, but basically an option's entire valuation or price is based on the fact that it has the ability to be converted into shares of stock at its strike price. So we'll go through a bunch of examples, so don't worry if this doesn't make sense quite yet. Option characteristic number.
Wes had a question, and I like this on the chat because I didn't notice it until I saw it here on the chat on the side of the screen. Can an option automatically exercise, or does it always evaporate? That's a fantastic question. Okay, so if it expires in the money, if an option expires in the money, I just turned on my little cursor thing here. If it expires in the money, which is how I roll, meaning it is lower in value than the current price, right? So 42.77, the 42.50s and below are in the money. In the money means it has intrinsic value. If you are holding that long option and then your option expires and it's in the money, the broker will automatically exercise that for you. Okay. Now that sounds scary, and you might get a margin call from it. Now I'll tell you one thing. I've had 2 margin calls in my life. Did I freak out? Did I piss my pants? No, just close the trade. It's not that scary. Not at all. But let's say that I bought one contract for $545, right? So I spent $545 on the contract, $545. Now remember that this is a this value times 100, so $545. And then I was not paying attention. It expired. Now I own 100 shares at $38, so plus another $3,800, right? Now if I don't have $4,300 in my account, I'll get a margin call that'll say, hey, you bought this option and it was exercised for $38. Congratulations, you own 100 shares of stock. Now if you don't have $4,300, maybe you only had $600 in your account, you now owe us the difference. Okay, so 43.45 minus 600, 37.45, which sounds scary, but all you have to say is, oh, never mind, I don't want those shares anymore. You close the trade and it's done. You close the trade and it's over. You close the trade and it's like nothing ever happened. Okay, now you might make a buck or lose a buck in between, like the market value changing, but it's really not that scary. So that's what I want to go over that with you, right? This video is going to take us like weeks and weeks to go through because I want to interject. We've done 2 minutes into it so far.
Number 3 that we have to discuss, and the final one that we will discuss before moving forward, is what is called the option contract multiplier. So this is really confusing, and I hate it myself as someone who teaches options because it makes things pretty confusing. But if I see a share of stock that has a stock price of $120, I can buy 1 share of that stock with $120. But if I see an option and the option price is $5, I cannot actually buy that option with $5 US. I actually need $500 because options on stocks can be converted into 100 shares of stock. And because of that, we have to multiply the price that we see by 100 to get the option's actual value, or what is called the option premium. So let's build on these 3 option characteristics.
Okay, so let's go back just slightly here. Looking at the option chain, if we find one for $5, right? It's not actual $5 US, right? We're talking this one right here, 545. It's this times 100, right? But if you think about it, you're really just breaking it down to per share. Okay, so per share, it's $5.45. But what actually comes out of your account, all option contracts are based on 100 units, right? So if I have 100 shares, then that's $545. So that's how I think about it, right? I can buy the stock for $5.45 a share. When you think of it that way, it makes it so much easier. Right now, of course, you got to know that it's this times 100, but I'm only buying it for $5.45 a share.
The actual value, or what is called the option premium. So let's build on these 3 option characteristics, and let's move forward by discussing the 2 option types and get into some examples. And
okay, but I like so Stumpy's saying it's a great idea, but this is being distracting. I don't know. I like it being on the screen. It actually helps me see your comments faster. Let's keep going.
And clearly look at what these 3 characteristics mean in regards to the examples. The first option type is called a call option. At a very high level, call option prices will increase as the stock price increases, and call option prices will decrease as the stock price decreases. So the price of call options moves with the stock price. But why do call option prices move with the stock price? Well, a call option gives the buyer the right to buy 100 shares of stock at the call option strike price between now and the expiration date of that option.
Okay. Remember what we just talked about a couple minutes ago. If I buy this option, I have the choice to buy this stock at this price. Remember, I, as the option buyer, have the choice. If I want to exercise the option, if I want to transfer the option into shares, I have the choice to be able to do that. And at $38, at the strike price that I bought it at. Now, could you buy a 47 call and exercise it? Absolutely. But that would be dumb. That would be super ultra dumb. Because if you bought it for 97 cents and then you exercised it for $47, your broker is going to be like, no, I don't think we'll do that. Your broker may not even let you do that, because that would mean you're buying the stock $5, $4 above the current price of the stock. I don't even think they'd be able to sell it to you for $4 or $5 above the current price of the stock. That would be so dumb. But in order to do the option, right, in order to exercise the option, it really needs to be in the money. There's 0 point whatsoever. Why would you buy a $47 stock when the stock is currently trading at $42.77, right? Yeah, doesn't help at all. So that is the point of this. Now, where was I going with this? Hang on. Now, as this is increasing, right? As this is increasing, as the price is increasing, the price of the option is also increasing, right? Because it's getting more valuable, right? If it's going from, and we can see it right here, if the current price is $42.77, in the money right here is $2.47. It's getting more valuable to buy it as it goes deeper in the money. We want to make sure that we're buying stocks, we're buying options that are getting more valuable. And they're getting more valuable because it is getting more intrinsic value. Intrinsic value is the difference between the current price of the option and the price of the stock. So for example, $38 plus $4.77 is $42.77. So as an option goes deeper in the money, it has to be more expensive because the intrinsic value is going up. And the intrinsic value is just current price minus strike price.
Remember that one of the characteristics of all options is that they have a strike price. And for call options, the call option can be used to purchase 100 shares of stock at the call option's strike price. And as we'll see in an example in just a moment, the ability to purchase shares at the call option strike price, which never changes, will get immensely valuable if the stock price increases significantly higher than that call option strike price, because the option can then be used to purchase shares of stock at a steep discount to the current share price. So without getting into an actual
steep discount to the current price, right? You don't want there's no reason to exercise out of the money. The steep discount comes when it's in the money.
Option or stock market example just yet. Let's explore what a call option does and how it works by using a very simple example. Let's imagine that there is a house and the current value of this house is $200,000. Now, I am personally interested in buying this house because I think that the value of the house is going to appreciate significantly over the next 2 years. But I don't want to buy the house right this second. So I'm going to buy an option that gives me the right to buy the house at a price of $200,000 between now and 2 years from now. So we can call the strike price $200,000, since my option that I'm buying on this house gives me the right to buy the house for $200,000, or at the strike price of $200,000 between now and the expiration date in 2 years from now. So that's what I'm going to do. I'm going to buy this option that gives me the right to buy this house for $200,000, no matter what the house price does between now and 2 years from now. But I don't just get the ability to purchase this house for $200,000 between now and 2 years from now for free. I have to pay for this contract because for me, there has to be some sort of risk. There can't just be reward. If somebody were to say, you can buy this house for $200,000 between now and 2 years from now, no matter what, and you don't have to pay for that right at all. Well, that would be amazing for me, because if the house price falls, I don't have to buy the house. But if the house price goes up to $300,000, then I can buy the house at $200,000. And there was never any risk for me, but there was only reward.
Okay, so let's use this as a house example, right? Let's say that you want to buy the house for $38,000, right? We can use that as a decent example. If you want to buy the house for $38,000, you can choose to at some point in the future, but you don't have to. You don't have to. But in order to choose to do that, you're going to have to pay $5.45. You're going to have to pay somebody $5.45 to hold on to that house for you and say, you know what, in the future, I might buy it at 38,000, but for now, just hang on to that for me, okay? And the broker's going to be like, well, sure, but it's going to cost you, right? Because now the price is at $42, and if it goes up to $50, right, that's going to be a huge loss for me. So you're going to have to pay me right now $545 to hold on to this house for you. So I like that example. It's a great example. Manny says, it explains the house. It explains it perfectly.
So that's not a real scenario. And for me, there has to be some risk. And what that means is that I have to pay a premium for the right to buy this house at $200,000 between now and 2 years from now. So we would call that the option premium. Let's say that I pay $10,000 for this option. So I'm saying I want to buy this house for $200,000, which is the strike price, between now and 2 years from now, which is the expiration date. And my premium for having that ability over that time frame is $10,000. Now let's say that 1 year from now, the house is valued at $350,000. I have possession of a financial contract that gives me the right to purchase that house for $200,000. And with the house currently valued at $350,000, what do you think that means for the value of the financial contract that I have, which is called an option? Well, as you might imagine, since I can buy the house for $200,000, but the house is currently valued at $350,000, the financial contract that I have, which is called an option, is immensely valuable. So now I can actually exercise my option, meaning that I will buy the house at the strike price, which is $200,000. And since the house is currently valued at $350,000, I am buying something that is worth $350,000 for a value of $200,000. And because of that, we could say that my profit from this scenario is $150,000.
Now, this is what we're doing when we're trading options. We're buying it at this price, and we're trying to sell it later on at this price and keeping the difference, right? The only way that that happens is if the price of the underlying stock goes up, because remember, we're trying to increase how much intrinsic value we have. Extrinsic value is going to go down every single day. So the only thing that we're trying to maximize is intrinsic value. We're minimizing extrinsic because this works against us, maximizing intrinsic because as it moves up, the price of the stock moves up, the more intrinsic value we get. And you can see right here, 27 cents, $4.77, $10.77. This is the value of that contract. Okay. This is what we're trying to maximize. And that's the difference between the 200 and the 350. But if it never goes to over 200, then what will happen is that this extrinsic value will tick down day after day after day. And if it's in the money and it never changes, this value never changes, right? So imagine SMCI stays at 42.77 for the next 9 days. The intrinsic value cannot and will not change because remember, it's the difference between the price of the stock minus the strike price. And so this 60 cents will go down. So we will lose money, but only in the extrinsic category, not in the intrinsic category. Now, in this example here, this is only intrinsic value. I don't see any example of extrinsic value in this example, but that's why I wanted to explain that.
So that's the golden scenario. Now, because I paid $10,000 for the option initially, my net profit in this case would not be the full $150,000. It would be $140,000. So my total profit minus what I paid for the option initially. So that is the golden scenario. But let's say the opposite happened and the house price did not increase and actually fell to $150,000 2 years from my purchase date of that option. Well, I don't actually have to buy the house for $200,000 because I had an option to buy it, but I don't have to exercise my right to buy the house at the strike price. So since the house is at $150,000, obviously I don't want to buy it at my strike price of $200,000 because if I really wanted that house, I could just buy it at the current market price of $150,000. And because of that, the option that I have is worthless. And since I paid $10,000 for that option and now it is not worth anything, I have lost my full $10,000 that I invested into that option. But if we compare this to the loss I would have had if I purchased the house initially without buying an option, I would have paid $200,000 for the house And at the current price of $150,000, I have lost $50,000 as opposed to the $10,000 that I lost in my option.
Actually, that's a really good example. I really like this. So we paid $10,000 for the contract. The value of the house was $200,000 when we decided to buy the contract, and then it went down to $150,000. Now, losing $10,000 that you paid for the contract sucks, but it sucks a lot less than having lost the $50,000 that you would have had you bought the stock out or bought the house outright. So this is actually a really good example. I like this. That's why this video has 17 million views, by the way. Really good examples. And so I like being able to go through this section by section with you. We won't do the entire video today, but let's continue on here. And then I want to look at some of your stocks in a little bit.
Premium example. So with the option, I only lost $10,000, but if I would have just bought the house initially, I would have lost $50,000. So with options, you have limited risk and immense upside potential, which is why traders love to buy options. So let's take all of these concepts that we just discussed with this basic house example, and let's look at it with a real option example in the stock market. And for this first example, we are going to be looking at a call option on Tesla, which is everybody's favorite stock right now. Unless you're short, then maybe it's not so much your favorite stock. In this real image of Tesla options, I have set up an order to purchase.
Holy moly, this is from 2020.
The Tesla call option with a strike price of.
Okay. I like this as well. Don't be intimidated. Focus on what I highlight. Now, I remember the very first time I saw an options chain, right? And you may have felt that way recently as I'm pulling this up. I remember the very first time I saw an options chain, and I said to myself, I have no idea what all these numbers mean. I just want to make money. So if you're looking at this and you feel intimidated and you feel like you don't understand what it is, I was there. Since then, I've made tons of money understanding what all of these numbers mean. So hopefully by the time we get through these series, you'll understand what all these numbers mean. But I get it. I completely get it. If you look at this with the deer in the headlights, I have no idea what this means. I just want to make money.
Of $800 and an expiration in June, which is 39 days away as of this image. The strike price of this call option is $800, which means that between now and the expiration.
Hang on, I'll make this bigger. That's better.
Expiration date in 39 days. If I own this contract, I have the right to purchase 100 shares of Tesla stock at the call option strike price of $800. So in our house example, it was just buying one house. So therefore, we would say the option contract multiplier in that case is 1. But in this case, since I can buy 100 shares of Tesla stock at the option's strike price, the option contract multiplier is said to be 100. And because of that, we have to look at the option's price and multiply it by 100 to actually get the option's value or option premium. Now let's note that the current Tesla stock price is $811. So the stock price is the current market price of the shares, but we are looking at a call option with a strike price of $800. In the bottom middle of this image, we can see that the option price is $81.70. But remember, this is not the actual value or premium of the option. This is the option price. To get the option's actual value or the cost of purchasing this option, one contract, is actually $81.70 multiplied by the option contract multiplier of 100, which gives us an option value or option premium of $8,170. Now, this is a really expensive option. Now, don't worry, because not all options are this expensive, but we'll talk about exactly why this option is so expensive in just a little bit. But why would this option be worth over $8,000? That seems a little bit crazy. Remember, a call option buyer can use the call option to purchase 100 shares of stock at the call option strike price between now and the expiration date. And in this case, the expiration is 39 days away. So let's say that I think Tesla shares are going to increase significantly over the next 39 days. I'm going to buy this Tesla call option right now with a strike price of $800, and I'm going to pay the premium of $8,170 to buy this call option, just one contract. Now, let's say 2 weeks from now, Tesla has had a massive rally in the stock price, and now Tesla shares are trading at $1,000 per share. Well, I have in my possession a financial contract called a call option that gives me the right to purchase 100 shares of Tesla stock at my call option's strike price of $800. But Tesla shares are currently trading for $1,000. So with my option, I could exercise my option, meaning I want to go through with what the option allows me to do, which is with a call option, purchase 100 shares of stock at the strike price. And if I do that, I will buy 100 shares of Tesla stock at the strike price of $800. So if we take $800 per share times 100 shares, I will pay $80,000 to buy that share position. But Tesla shares are currently trading for $1,000. So if I go ahead and turn around and sell my shares, if I sell 100 shares for $1,000 per share, I will receive $100,000 for selling those shares. So my profit in this scenario is $200 per share multiplied by 100 shares, giving me a $20,000 profit. But remember that I paid $8,170 for this option initially. So my $20,000 profit minus my initial cost of entering the trade of $8,170 gives me a net profit of $11,830.
Okay, hang on before he moves that slide. This is how you can have unbelievable returns with options when the stock doesn't do all that much. Like, for example, this goes from, let's say, roughly 800 to 1,000. That's about roughly a 20% increase. But your options have a 145% increase. That right there is the seductive nature of options. And when you understand how to do it, it changes everything, right? So the stock can go up 20%, your option can go up 145%, or depending on the options, multiple hundreds, maybe even thousands of percents, right? There's lots of different ways that you can make a lot of money in options. I saw a question from Golden Oldie. Question: in reality, are option traders usually interested in exercising the option or just more interested in buying, selling the option? I will tell you, I have been assigned twice. Well, the options were given to me, which we'll talk about that later when we talk about selling options. And that's when I got the margin calls. But no, I had no intention whatsoever of taking the actual options. Not at all. I don't know any option trader who actually is like, oh yeah, I would love to pay $500 for the contract, right? Going back to this, I would love to pay $500 for the contract, so then I can buy it later on at 38, right? I have to pay here and I have to pay here. No. They want to make sure that that 545 turns into $11 and then get out. They don't want to have to buy it twice, basically. So no, I don't know of anybody who ever actually goes through to exercise the options. Sylvia had a question. What happens to your option contract if the stock splits? Now, I've seen this before, and what happens is all these numbers on the screen, they get really wonky. Rather than like a 3250, it'll be, I kid you not, it'll be something like 3267. And then the next one will be 3290. And then the next one will be 3315. It goes crazy. But you are still entitled to be able to buy that. And the market makers will adjust your strike to be the appropriate strike as if you had bought it the second way, right after the split. But yeah, it gets really wonky. It's really ugly looking. But it does work itself out. Let me see. So Salty Brad says, is that based on delta the strike price had? I'm not sure what you mean by is that based on delta, but the delta over here is a great way to look at how much the option prices increases for the $1 change in the stock. And I'm sure that he'll cover the Greeks later on. But at the 38 strike, this means that for every $1 that the SMCI goes up, this will go up by 82 cents. Right. So my 545, if it goes up by $1, will be 545 plus 82 cents. So that's what the delta means. I believe we're almost to the section where I wanted to stop, and then we'll take a look at some of your stocks.
$70 gives me a net profit of $11,830. If I make a profit of $11,830 on an initial trade cost of $8,170, my return on that position is 145%. So the reason a trader would pay so much for a Tesla call option is because Tesla shares are incredibly volatile and can move around hundreds of dollars in just a few days' time. So if a trader believes that Tesla's stock price is going to surge in the near term, they might buy a call option. And by doing so, if they buy the call option and then the stock price increases significantly, the value of their call option will also surge because the ability to buy shares of stock at the fixed strike price gets immensely valuable as the share price rockets to higher and higher prices. But we need to discuss something that's extremely...
There we go. Okay, so we're going to stop at that point right there. We'll come back to this. Now, Optic Blast had a question. Why did last week you won big on Palantir and Hood? Thank you very much. Why did you roll your calls? Why didn't you just hold? You were up bigly. I was still up bigly. I was bigly up the entire time, rolling or not rolling. The reason to roll is actually awesome, right? I'll give this example. So actually, let's do. Let me go to my broker real quick. I wanna show you the strikes that I rolled around from because I don't remember off the top of my head. Hold tight. All right, so we'll just do hood. So I originally bought the May 30th on hood. Bought the 48 calls. Bought the 48. When I bought it, it cost me. What should it cost me? $7.50. Let's pull up a spreadsheet here. All right. So I bought it for $7.50. So let's say I spent $7.50. That's why I'll put negative. Then I rolled up the option. So that was the 48 strike. Then I rolled up to the 53 strike. And when I did, I got paid $4.12 to do so. So now my risk in the trade is the sum of those two. So my risk in the trade went from $7.50 to $3.38. So my risk is now how much percentage? So I have 45% of the risk that I did initially. And I'm still holding the trade. And then when I closed it, I got to close for 1065. That was when I closed the 53s, right? So now 1065 minus this amount equals this plus this. It's how much my actual profit was. And that divided by the initial outlay means a 97% gain. So here's the thing. I used this analogy last week and it really made sense to a lot of people. I bought the initial 48 strike as if I bought speakers, right? Bought speakers from Costco. And then I went back to Costco and I said, you know what? I don't want these speakers anymore. And Costco said, okay, cool. So here's $4.12, right? And you can keep the speakers. So keep the speakers. But here's a refund for $4.12. Okay. So I bought the speakers. I took them back because I don't like the speakers anymore. And they're like, here's what we're going to do. How about we give you a partial refund and then you can decide later on if you don't want to keep the speakers anymore. So then a few more days goes by and I go back to Costco and I return them. And Costco gives me another $7.27. So I bought it for $7.50. I got a partial refund, but I got to keep the speakers. And then later on, I really decided I don't want those speakers anymore. So then Costco's like, cool, no problem. We'll take them back free this time. And then we'll give you $7.27 on top of that. That is my best explanation on how to conceptualize why we do this. Because first, it reduces risk. I can now trade with that $4.12 that I didn't have in my account before because it was locked up with the original purchase. And then later on, I still get to sell it back. So I get to roll it from here to here. So this is my initial. This was what I rolled it to, and I still get to sell it back later on. So it decreases risk. It takes partial profits now, and it allows me to keep the trade on. So later on, I can even make more money. Charlotte's brain just imploded. That's okay. That's why we're going to go through all of this, right? And of course, be sure you tune into Outlier University. So I only got a couple minutes. I'm actually running a little bit behind schedule at this point. I'd like you to put your stocks in the chat. We're going to go through some with the Outlier 9. The Outlier 9 framework is exactly what I look at when I'm looking at a stock. So first, let's start here. We're going to look at the trend, the signal, and the breadth of the market right now. So first, let's go to SPY. So we can pull up SPY right here. We can see it's still sitting on a buy signal. Nico, good question. Do you roll up to the higher strike in the same expiration or same strike and longer? So one of those is rolling up, one of those is rolling out. You can do both. You can roll up and out. But for this example, I rolled up. Now, in order to get a credit, if you roll out, you will have to roll up because the same strike from one to the next, you're going to have to pay a debit. If you pay a debit, you are actually increasing the amount of risk in the trade. If you roll for a credit, then you actually get a reduction in risk on the trade. So we're looking at this. We can see the green overlay means the market is in a bullish trend. We've got a buy signal. The fear and greed on the stock has gotten pretty high. On SPY's fear and greed's up at 82. Thank you. Who said that in the chat? Yeah, Rick, right there. See, if I hadn't seen that on the little chat roll, I wouldn't have noticed it. Yeah, fear and greed's getting actually really, really high for SPY. I would absolutely think that we're due for a snapback anytime soon. But gotta follow the plan here. The trend is bullish, the signal is bullish, and breadth, this is what we talked about earlier, actually has finally crossed down on the full stocks. That's what I look at. The market breadth has crossed down. Now, that means that of the Outlier 9, we can't have a perfect score because this would be bullish, this would be bullish, this would be bearish. Now, let's look at a couple. Let's look at Master Killa. What's going on, Master Killa? Let's look at NBIS. Oh, do we not cover NBIS? NBIS. No, it looks like we don't. That's all right. We covered 2,600 stocks, and we are adding more in the near future. So we'll take a look at NBIS for you on the chart. So NBIS actually has a great setup here. You got your 10 over 20, price over 50. So we can still see the trend of the stock is moving higher. We don't know the signal or fear and greed here. And then there are no outlier blocks in the way of it. So this looks great. This really does look great. What I would do in this case is I would have my trailing stop be that 10 period EMA, the blue line right there. I would let it run as far as it can. I don't have enough data to give a fear and greed score on this, but I would let that run as far as it can. Then once it closes under the blue line, that would be my exit signal. We don't know how often that'll happen, or we don't know when that'll happen, but you got to let it run as far as it can. So great one on that. Jameis has a question. When we buy a call option, who is the seller? Is it the broker or just a random guy on the internet that's selling the option on the broker's platform? It's kind of both, right? It's going to be market makers because they are doing all kinds of stuff in the back end to hedge their risks, right? Market makers are there to facilitate trades. Market makers are there to make sure that if you want to make a transaction, you can make the transaction, right? Otherwise, there's no liquidity. Nobody can do anything. So it's kind of a combination of the two. Let's see. Mike. Let's look at Mike real quick. Mike wants to look at PG long, Procter & Gamble long. Click the right button here, Chris. Procter & Gamble long. So let's work over here. PG. Oh, I did PGR. We'll just do PG. All right, looking at Procter & Gamble. This is in the staples sector. And the staples sector is actually doing really well. So we already know the market. Let's look at the sector, the fear and greed of the staples sector. This is the average fear and greed score of the staples sector, and it's rising. That's what we want to see. Next, the breadth of the staples sector. We can see it right here. It crossed over the 10 EMA of the breadth right there. So it has a bullish crossover on the market breadth for that sector. Next, the trend of the stock. We got a green overlay right here, which means the 10's over the 20, prices over the 50 with a buy signal. Okay, trend, signal, fear and greed. We want to make sure that that's increasing. So we can see that it peaked on fear right here and is starting to decrease fear, increase greed. So that's good. Now let's look for any outlier blocks in the way. PG. And I don't see, hang on, let me double check and make sure that they are turned off. My bad. Let's turn those back on. And then we need to go back to the one we were just looking at a minute ago, NBIS. I had turned those off yesterday. Okay, it's still good. It's still good. Let's go back to PG. Okay, so you do have some outlier blocks overhead at 168, but you've still got some room on this one. So that is how I would analyze the stock, the Outlier 9, right? Now, we don't have the full Slingshot setup here because the breadth is bearish right now. but everything else is there for you. Now, what does that mean? It means you got to come up with your own plan. And your plan may say, I'm good for 8 out of 9, right? I'm good for 7 out of 9, whatever. You decide where this is best for you. But other than the market breadth, it's really set up. Let's see. Skinny Buff Guy has a question. Now that the full stocks list has crossed the 10 EMA and is showing bearish, if you were a buy and hold on the SPY, would you close your position? So probably, because my exit rule, go to my exit rule here. Actually, I'll tell you exactly what I would do. My exit rule is if the sector and the market breadth both cross, that's where I would get out. So the market breadth on the full stocks has crossed to be bearish. We can see that right here. If we go, imagine that's the market, and then we go into the sector being the S&P 500 market breadth. Let's look at this. S&P 500 actually is still really high. So maybe not. But the market trading versus the individual stock trading, a little bit different between the two. The market is generally a lot more resilient than individual stocks. So if I were applying my same rules, I would actually not be looking to close today. But once the sector and the market both turn, that's when I'd be looking to get out. Listen, if you're ready to save time, make money, and start winning with less risk, you should watch one of these 2 videos.